Good morning. Good morning. Good morning. Good morning. Hi, Rashmi. Good morning. Anirudh, Archit. Hi, welcome. Bijal, Birendra Jain, Vishwanath. Hi, welcome. Good morning. Yagnesh, Darshana, Chaitanya, Dipalok, Hausala, Rishikesh, Karthikeyan. So nice to meet all of you. Pradeep, Prajakta, Pushpanjali. Hi, welcome. Sachin, Srinivasa, Varsha, Yagnesh. Great. Chalo, let's get started. Okay, so today is the last of the session on interest rates, right? And today we are going to look at a different angle and bring in that perspective on interest rates about how an advisor, hi Nikhil, good morning. So, how an advisor can bring about that perspective and the thoughts and while you're building authority in front of the client. Okay, so just still so far we have been discussing uh, interest rates, bond deals, the linkage between interest rates and price equity and so on. मुझे अभी ये बताए, when you are having a conversation with a client, okay, you are having a conversation with a client and the client asks, should I invest in equity now? What do you really check? बताओ तो। क्लाइंट के साथ बातचीत हो रहा है, क्लाइंट ने ये सवाल किया, शुड आई इन्वेस्ट इनटू इक्विटी नाउ? व्हाट डू यू गो एंड चेक? प्लीज राइट इन द चैट बॉक्स. Okay, you will ask for his timeline, you will ask for whether it's long term, short term, okay, and you will check the asset allocation. All right, and you would also look at the current nifty level. Okay. Hmm. How inflation will be for 3 months. All right. You will check the Nifty level. Yes or no? How many of you will check the recent returns, fund ranking, market move? How many of you will check the fund manager view? Hmm? We are going to check many of these things. And how many of you will actually check whether money itself has become expensive or cheap? How many of you will check whether inflation is eating the return before the client even receives it? How many of you will check whether a 7% yielding FD is actually giving wealth creation or only giving emotional support? How many of you will check why gold has suddenly started to go up when real rates have started to rise? How many of you will check why FIIs sell Indian equities even when India's fundamentals look so strong? And will you ever check why a debt fund has given a 10% or 12% return in the last 1 year, and then it is becoming flat the next year? Most advisors don't do this. Most advisors don't do this. Handful of advisors definitely do this. And most advisors only track the visible market. But the real market moves below the surface. Interest rates are not just numbers announced by Reserve Bank of India. They are hidden operating system of every asset class. They decide how equity gets valued. They decide whether debt funds make capital gains or losses. They decide whether foreign money will enter into India or exit India. They will decide whether gold will become attractive or not in the next 1 or 2 years. They decide whether banks were going to lend aggressively or they're going to become cautious. And it will also decide whether your client's FD is actually preserving the purchasing power or quietly destroying it. All of that will be determined. So today, we're not going to discuss interest rates like the previous few sessions, like somebody is reading a newspaper. We're going to go discuss interest rates like a true advisor. Not like repo rate bada hai to ghata hai, kya hai. But what is the real return after inflation? What is the signal from US rates? What is the duration telling us? What is RBI doing, doing through liquidity? And where are the credit spreads? Because clients do not need the market commentary. They are looking for someone who can decode what is changing, why it matters, and what they should be doing in such a situation. Okay? All right. All the best. And let's get started. Perfect? Super. Just a minute, and I'm going to download my presentation. And let me know once this is visible. Yes. Is it visible, please? Can somebody please confirm whether it's visible? Okay. Thank you, Sagate. Okay. देखो, so there are 2, 3 ways of looking at the markets. Okay. So one is the looking at the nominal numbers, relying on our portfolio 60-40 of the times, reacting to news headlines, and treating debt fund as a one-time smooth kind of investor. The other deeper way of looking at markets is trying to see whether the purchasing power of our consumers and investors are changing over time. We are looking to predict risk via the credit spreads, where we can understand the global capital flows, right? And executing tactical duration. Macro frameworks actually show what happens next, not what is happening. So first thing to look at is the real rates and the nominal rates. So the nominal rate is the yield that we are generating from our investments. Like an FD, if it is generating 7% coupon, so the nominal is 7%. Then there is a taxation, 30%, if you're 30%, 20%, 10%, there's a tax. And then there could be an inflation. Correct? So all of those, first tax takes away some income. Then inflation also takes away the potential income. What is left is the real return. Many a times, the real return can actually turn negative. Okay? The first thing to keep in mind. Using real rates will help us to dictate the asset allocation. Because, there are 3 ways to look at it. One is cash, which generally people try to avoid, but many a times cash actually also generates a positive return. So it's absolutely fine to hold on to it at times. Okay. Then there are mildly positive zones where RBI's comfort zone. So the Monetary Policy Committee framework actively targets keeping the policy rates in this 100-150 basis points, this positive zone. In this, the allocation is balanced across all the asset classes. And then comes the strongly positive zone, where debt is genuinely attractive and you are locking into long duration, where there is a potential possibility of interest rates moving lower. Okay. Now, there is again the FII ways of looking at things because they are a reasonably large investor in India's markets. Now, there are US yields and there are Indian yields. Okay. The difference, sometimes we keep it hedged, sometimes we keep it unhedged. Okay. So currency hedging, the cost of hedging the currency risk is something which determines whether the FIIs are going to eventually bring in money into India or they're going to pull out money from India. Okay. Because the foreign investors borrows in the low interest currencies. They will borrow in USD, they will borrow in Euro, they will possibly borrow in Japanese yen, and they're going to deploy into higher yielding markets like India. So they're going to borrow cheaper and they're going to invest into India. Now, whether are they going to invest naked? Many a times the answer is no. They would actually hedge the position. When you are hedging your bets while you're investing into India, if that hedging cost is high, it is going to eat into the potential spreads. So the hedging cost is one element that one level goes deeper in terms of understanding. Lens number 3, the deep divide between accrual income and potential capital gains from duration movements. Now, in this world of duration, there is a Macaulay duration and a modified duration. It's very simple maths. If a duration of 6 means if interest rates go up by 1%, price will drop by 6%. Very clear. And if interest rates go down by 1% and the duration is 6, that means price is going to go up by 6%. Okay. There are two ways to make money. One, when you buy and hold something, which is the accrual philosophy. You hold it to maturity. The total return that you generate during that time is just the coupon. It is very steady returns, predictable outcomes. Okay. The duration concept is when you're taking bets on interest rates. That means you are taking a call whether interest rates are either going to go down or it's going to go up. And they are volatile, okay? And they give you absolutely explosive kind of returns during falling interest rate cycles. And that is how sometimes you are able to generate additional alpha from the market. Remember, in equity, the question is, which stock do I invest into? When you're investing into debt, the question is, what is the duration in which I'm looking to invest into? Sometimes if you get the duration wrong, you might be completely losing out the upsides from the market. Now, how do I execute this debt cycle clock? When interest rates are at their peak and expected to fall, okay? So the play is maximize the duration play. Deploy into long duration funds, long duration, really long, like 5 years, 7 years, and so on. Or maybe gilt funds. When rates are rising and more rate hikes are potentially ever, then you are looking to protect your capital. Then you would deploy into liquid, ultra short, low duration kinds of stuff. When interest rates are largely flat, at that point in time, you are just a carry game. You would buy and hold. You invest into corporate bonds, banking, PSU funds, and so on. And when the curve is an upward sloping, normal looking yield curve, that means the 7-year yield is higher than the 5-year and the 5-year yield is higher than the 3-year. Okay. Then you play on the roll down. You invest into something which is, let's say, 7-year, sell it off when it is at a 5-year, then again go back and then invest into something which is 7-year. Okay. Now, there's a fourth way. Repo rate. The repo rate is what is visible to everyone. Then there are certain things which is happening underneath it, which is we have the CRR, which is draining out liquidity or pumping in liquidity into the system. Then we have the open market operations going on. And that actually determines whether more money is getting into the system or getting out of the system. Open market operations are managed by either buying government securities or selling government securities. And then there is a variable reverse repo rate auctions, which determines the short-term liquidity. RBI can keep this repo rate flat and still tighten the systemic liquidity aggressively. Okay. And how do I trace the overall effect of liquidity? Now, when systematic liquidity is shifting, let's imagine it is now moving towards a tight liquidity conditions. Then NBFCs struggle to raise funds. NBFC stocks fall, credit spreads widen, and credit risk funds NAVs drop. Sometimes the spreads widen far more, become from the comfort zone, and EMI starts to go up. During easy liquidity conditions, excess funds get into the market through the banks. Carry trades become quite an attractive zone to be in. Equity starts to rally. Gold often rises alongside. Remember, everyone watches the repo rate because that is the rate which is visible. Okay. But there is something else which determines the movement in the market, which is liquidity, and that is managed by your open market operations, CRR and VRR. The credit spreads, the difference between the spread of a AAA and a GSEC, AA and a AAA, single A and a AA, that's the spread. That is the ultimate stress detector. Remember, in the world of debt, an 8% yield doesn't always mean that 8% is absolutely superior compared to 7%. In the world of debt, yield is an indicator of risk, not just return. The credit spread is the extra yield demanded to lend to a corporate because of the additional risk that the company is carrying. Okay? So, when does bond markets blow up? When it is indicated through the credit spreads. Bond market smells this credit risk first, and then there could be a potential downgrade in the credit ratings, and spreads continue to go up, and then potentially it's felt in the equity prices. Bond market investors are the people who get a sense about what is going to happen next much sooner than equity investors. YTM. Any debt fund which shows a YTM which is significantly above the GSEC yield is taking significant higher levels of credit risk, right? And it could be lower or higher, but it is an indicator about what's really happening within the system. The spreads could be wider for NBFC companies, it could be wider for real estate, could be PSUs for lower rated companies, and so on. Remember, YTM is a measure of the risk matrix, not just as a return metric, as I mentioned. Okay. So what are the few big ones to look at? Purchasing power, capital flows, what is the shape of the curve? What are the hidden levers and the early warning signs? These 5 metrics operate simultaneously. Together, they will transition a portfolio from reactive mode to a proactive mode. Remember, equity markets show you panic. Bond deals show you the direction. And credit spreads show you exactly where the cracks are forming. Understanding each of these individual products is just understanding the entire ABCD of interest rates. And integrating real rates, global capital flows, duration tactics, and systemic liquidity and credit risk detection is ultimately becoming a master of this space. Before I let you go today, I have one request. So just give me a second and I will let you know what exactly I am looking for. And next week, we are going to go deep into this world of macroeconomics and pick up one more action point on this world. And so it's been some time that we have been conducting these sessions. I'm going to paste a link in the chat box. Okay. I'm going to paste a link. Yes, that's there. If you are really liking this series, please do let us know what you're liking. We would love to hear your Google reviews. If there is anything that you want us to improve upon, please do write it there. Okay. It would be really our honor to receive each of your feedback. We would respectfully read everybody's feedback and incorporate them in our sessions going ahead. All right. Have a great day ahead. Have a fantastic weekend. And I'll see you on Monday at 10:10. But with humble request, if you could click on the Google review link and share your reviews, it will be an absolute honor to receive and read everybody's. I would definitely go through everybody's reviews one by one. All the best, everyone. Have a fantastic day and keep growing your AUM. Take care. Bye-bye.